Credit scores are small numbers. They appear on a screen, they appear on a piece of paper. For many, they feel like a final grade on a financial report card. Most people think scores simply reflect how good or bad you are with money. That is a simple story, but not the full one. In truth, credit scores are powerful tools, designed to measure past actions, designed to influence future ones. They subtly guide how individuals behave, and, more overtly, how institutions, like banks, make decisions. These three-digit numbers have woven into daily life, shaping opportunities far beyond a loan. The core idea is simple. The first and most crucial idea to grasp is that credit scores are designed to measure behavior, not character. The score does not know if you are a kind person, a hard worker, or an honest neighbor. It only knows what the data tells it about your past financial transactions. Its memory is long and its focus is narrow. It concentrates on how you've managed debt and payments over time. It records late payments on credit cards, the types of loans you have secured, the length of time your accounts have been open, new accounts you've recently applied for, and your debt relative to available credit. These data points feed a scoring model built on history from millions. It associates patterns with higher or lower likelihoods of default. Imagine a simple scenario. Two people apply for the exact same car loan, both earning $60,000 per year. Sarah has had a credit card for 10 years, always pays on time, and keeps her balance low. John has a shorter credit history, missed several payments 2 years ago after an unexpected job loss. Looking only at scores, Sarah appears low risk and John appears high risk. Sarah will likely get a low interest rate, John may get a much higher rate or be denied. This shows the system working as designed. It's not about traditional fairness, it's about risk mitigation for the lender. Scores standardize how applicants are differentiated, helping lenders price risk, channel capital toward predictable histories, and away from those who seem less stable, without capturing causes like job loss or recovery. The most direct beneficiaries are banks and financial institutions that lend money. Before credit scores, lending was localized and labor-intensive. Interviews, employment verification, and subjective judgments were common. Scores automate and standardize the process, letting lenders decide quickly and cheaply. They scale operations and increase profits. Scores manage risk across portfolios by sorting applicants into tiers. Rates and fees are set to cover expected losses. Lenders can serve more people at prices protecting margins. Scores provide a data-driven rationale that deflects claims of arbitrariness, even when outcomes differ across groups. Landlords, employers, and entire industries adopted credit checks as quick proxies. A vast industry, bureaus, FICO, brokers, analytics, fintech, thrives on the power of one number. The subtle truth is how scores actively shape our choices. Tying a number to life outcomes creates incentives to modify behavior. This is the essence of its control. Knowing a late payment can lower your score and block a mortgage, people prioritize that payment over other expenses. Learning that opening many new cards is negative, they become cautious about new credit. The score nudges toward disciplined habits, encouraging strong payment histories and responsible debt management. A clear goal can empower people to improve finances, unlocking lower-rate mortgages or business loans, a ladder for those who master the rules. But the system favors stability, predictability, and long engagement with formal credit, penalizing lives that don't fit the pattern. Beyond nudges, the system carries hidden costs and traps. Models are limited by the data they can see. They excel at formal credit obligations, but are often blind to other responsible behaviors. A decade of on-time rent may not be reflected at all. Same for utilities and regular services. This creates the credit invisible and thin files, new immigrants, young adults, people avoiding debt. Lack of data becomes uncertainty and risk. Many receive low scores not for mismanagement but for no scorable history. Self-fulfilling prophecies emerge. Starting low means worse offers, high APRs and fees, making debt harder to manage. One miss sinks the score further, locking people into a costly downward cycle where the score becomes a wall. At its heart, the scoring system prioritizes efficiency over context. At scale, deep qualitative reviews are infeasible. One number enables a low-cost first pass, automation, reduction to a single data point, and uniform rules. This drive for efficiency made scores dominant. But nuance is lost. A number cannot tell the full story. It can't explain illness and recovery or support networks supplementing low income, or that a bankruptcy followed a failed venture with lessons learned. Scores reflect past data, not future character, resilience, or potential. Simple number, complex life. Details are lost. The system favors predictability and stability, struggling to price non-traditional lives. Institutional efficiency can become personal inequity. Those harmed are lives that don't fit the clean, predictable model. Borrowers facing job loss, medical emergencies, family crises often see scores fall through no fault of their own. Hardship leaves long-lasting marks, making recovery slow and expensive. The system lacks mechanisms for compassion. It brands risk for years. Young people and new immigrants arrive with thin files. Absence of data reads as risk. They can't get credit without history, and can't build history without credit. Historical inequalities echo in data. Proxies can induce discriminatory outcomes without intent. Bias gets laundered into seemingly objective math. Human stories, determination, untracked reliability, potential, are missed. It harms people needing second chances or with unconventional paths. The cold logic creates a standardized path to inclusion. Anyone who strays risks being left behind or penalized for deviation. Step back, and a clear picture emerges. Credit scores are not, and were never, measures of worth or character. They are tools to make lending more predictable for large institutions. They measure past behavior, reward stability, and nudge toward uniform conduct. This helps lenders be faster, cheaper, more scalable. But efficiency isn't fairness. The system is built on predictability. It rewards those fitting the pattern and penalizes those who don't. It creates traps and barriers. Stop seeing a moral report card. See a tool of economic control, a design reflecting risk management and profit. Ask if it aligns with fairness. Should one number govern housing, employment, insurance? Challenge status quo. Limit score use in non-lending. Include holistic data like rent and utilities. Individually, pull your reports. Understand what helps or hurts. Dispute errors and demystify the number.